Which are the top stocks to buy? That's the kind of question that many YouTubers ask and many investors ask. But the question is, how likely are you to pick those top performing stocks? And in this video, we're going to look at the exact statistics for that and its very important consequences for how you manage your portfolio. Now, I found the statistics pretty shocking, and I suspect you will too. Now, if you do want to support us, a great way to do that is directly on YouTube. You don't have to go to Patreon. If you want to do that, just click on the join button, which will be at the bottom of this video, or on the link beside me or in the description. And then you can have a wonderfully designed icon next to your name, and we'll push you to the front of the queue on our YouTube live sessions so that your question will be answered first, and we'll answer your comments on YouTube as a priority. So now let's look at the statistics for top performing stocks in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So what are the shocking statistics that I mentioned? The first shocking statistic we'll look at is the percentage return over the entire lifetime of a stock. That's from the time it's issued in an initial public offering until today, or the point at which it died in a bankruptcy or a merger. And those returns will be relative to cash, very short-term treasuries, which effectively have almost no risk and very little return. And the second shocking statistic will be looking at the performance of individual stocks versus the broad market. How many outperformed the broad market over their entire lifetime? So our first question is, what percentage of stocks had a positive lifetime return? Here you can see the US listing of Deutsche Bank since it was first listed on NYSE, the New York Stock Exchange, in 2001, when the price was around $43. And if we look at the most recent data, Deutsche Bank is now trading at about $14. So there we'd be looking at a very large destruction of your wealth over that 21-year period. The stock has underperformed just a cash-like treasury investment. Best & Binder's analysis extends that kind of analysis to 26,000 stocks since 1926, and brace yourself, he finds that more than half of the stocks underperformed T-bills. In other words, you'd have been better off effectively in cash than being in those stocks. Perhaps even more shocking is that the most likely outcome for those stocks was 100% loss of your capital. And that's because eventually many companies ended in bankruptcy. And Best & Binder's research was in an article that was written by Robin Wigglesworth in the FT, where he showed this beautiful graph. Now the y-axis of this graph is the number of companies that falls into a certain return bucket over its lifetime. And the x-axis below me is the return on the stock over its lifetime. Now that's not a percentage, you'd have to multiply by 100, and it's rounded to the nearest 5%. And you can see the most likely outcome for more than 3,000 companies in the database was a minus 100% return. And in fact, a very large proportion of the stocks you can see had a return that was less than zero, a negative return over their lifetime. And once we get to returns of around 200% or 300% over the lifetime of the stock, the numbers get very small indeed. And a lot of the clickbait on YouTube is about 10 baggers. Now these are stocks which increase their price tenfold over some period of time, in this case over their entire lifetime. And you can see those are extremely rare. These really are needles in a haystack. Now there are other people who've looked at the same data from CRSP, and this is from a paper called The Capitalism Distribution, written by Black Star Funds. And if we look at the number of stocks which had a negative return over their entire lifetime, that was 39%. So about a third of the stocks had a negative return, about 2/3 had a positive return, but the good news is that about 20% of them had a more than 300% return over their lifetime. Instead of comparing performance with T-bills, we can compare the single stock performance versus the entire market. And for the broad market in the US, they've used the Russell 3000 index. And again, we've got this 2/3, 1/3 split, where 2/3 of the stocks underperform the market over their lifetime, and about 1/3 outperform the market over their lifetime, and 6.1% of them, very few, dramatically outperform the index with returns of 500% or better. Another way of looking at this is if we take the combined wealth creation, the collective return of all of the stocks, and look at the contribution from each stock, how much would it give to the overall return? And there you can see the massive drag from 3/4 of the stocks, which had a total return of 0% or less. But then 25% of the stocks accounted for all of the overall gains. They did the heavy lifting because of their spectacular outperformance in a few cases. So why is it that so many stocks perform so poorly? Well, let's imagine for a moment that the distribution of returns over the lifetime of a stock looked something like the shape above, which is a normal distribution. Now notice that this distribution is symmetric. It's got the same number of cases on the upside as it does on the downside. The other strange thing about this distribution is that the mean, the average of the distribution, is the same as the median. Or another way of stating that is that half of the individual outcomes in a normal distribution are less than the average outcome, and half of them are more than the average outcome. But in practice, the actual distribution of returns over the lifetime of a stock are skewed to the upside. Now notice in this case, the median or typical outcome for an individual return is less than the mean. And that's the hallmark of a positively skewed distribution. And again, to paraphrase that, for a positively skewed distribution, most of the returns will be less than the average return. And that has some very important consequences. And if you're wondering why those lifetime returns are positively skewed, even if the daily returns were normally distributed, they're actually not. They are also a little bit skewed to the upside. And if we build in a 6% annual drift with 2% volatility, which is fairly typical for stocks, what you end up with once you compound those returns over a period of a year is a positively skewed distribution. And if you compound over an even longer period, which is the average lifetime of a stock, which was around 7 years for this database, you get an even more positively skewed distribution of return. Now, what does this all mean for us as investors? And these are some interesting conclusions which are made by Bessenbinder. The first one is that if you have an undiversified portfolio concentrated in a few stocks, then on average that's going to underperform the overall market more often than not. And consequently, that reinforces the desirability of low-cost and broadly diversified strategies for many investors. In other words, the passive approach of buying an entire index and buying it at very low cost. But the conclusion from the paper that all of the active fund managers have picked up on is that active stock selection can massively outperform, but only if you're fortunate, i.e. lucky enough, or skilled enough to pick the right stocks in your concentrated portfolio. But of course that begs the question, can individuals choose those home run stocks, the 10 baggers, which will massively outperform? Or alternatively, choose a manager which can select those stocks? Now, of course, active fund managers say, yes, we can find those stocks. And this is an article by Lawrence Burns quoting the Bessenbinder research, which was published in the FT. But if we look at the actual statistics of underperformance over a long period of time, and this is looking at the US over a 20-year period, you get underperformance about 76% of the time, up to about 94% of the time, depending on the type of fund. So if you did want to find one of those 10% or 15% of active funds which outperform over a 20-year period, how would you go about it? Many people use recent returns to try and gauge future returns, but it turns out that that's a very poor way of selecting active funds. So let's say you look back over a 4-year period and you identify the quarter of funds which perform the best over that period, and you buy those funds. Well, it turns out that only 2% of those outperformers will still be in the same league in the next 4 years. And that strongly suggests that it's just luck rather than skill which generates outperformance for active managers. But regardless of whether it's luck or skill, this creates an identification problem. How do we find those funds which will outperform? All we can really do is find an investment manager that has a style which we like, and which we trust, because ultimately it's going to be a matter of faith. So why is it that these passive funds have performed so well given these atrocious statistics? Well, usually the index which a passive fund tracks will be market cap weighted. A market capitalization, remember, is the number of stocks which are available to trade multiplied by their share price. So if a stock is successful, its share price will rise, its market cap will rise, and eventually it'll get included into the big benchmarks. And stocks that fail will have share prices that fall, their market cap will shrink, and eventually they could even get removed from an index. So there's a continual churn of stocks which are being added to indices and removed from indices. And if we look at the S&P 500 index in the US, there are many criteria which a stock has to meet in order to be included. Obviously it has to be a US company, but it also has to have a minimum market capitalization of about $12 billion at the moment. It's also got to be highly liquid so people can easily buy and sell the stocks and also cheaply buy and sell the stocks. And the stock has got to be profitable. So for example, Tesla couldn't be included in the S&P 500 until the most recent quarter's results showed a positive profit. The name passive I think is misleading because even passive funds are selective about the stocks they buy. There are quite strict criteria which determine which stocks can go into an index, which is then tracked by passive funds. Now in Besson-Binder's 2020 paper, he lists the 50 stocks which have created the greatest wealth overall. And if we look at some of those names like Apple, Microsoft, Amazon, Alphabet, which is Google, all of those stocks are included in the top 10 constituents of the S&P 500. So if it is the case that the outperformers of the past continue to outperform in future, then market cap weighted benchmarks will continue to pick up on that success. And that's certainly been the case over the last decade with mega cap tech stocks in the US. So you're obviously not going to have huge outperformance as you might do with an actively managed fund, but remember that most of those actively managed funds don't outperform net of fees. Now, if you do want to learn more about investing, a great way to do that is by joining our Patreon community. You can do that by clicking on the link beside me and in the description below me, and then you'll have access to Slack and also a growing library of video content to which you'll have immediate access. And as always, thank you for listening.